Most of us are conditioned to view the stock market as a high-speed casino. You place your bets, try to predict the future, and hope you get out before the house takes your money. The reality of building wealth is exactly the opposite. It requires ignoring the noise, acting entirely against human nature, and adopting a strategy that is, by design, incredibly boring. Author and investor Sven Carlin breaks down exactly how to do this in modern value investing. He takes the legendary principles developed by investors like Benjamin Graham and Warren Buffett and adapts them to the rapid, tech-heavy markets we face today. By isolating 5 core takeaways from his research, we can map out a contrarian strategy to identify real value and protect our capital from the crowd's irrational behavior. The first takeaway is entirely psychological. You have to separate your daily lifestyle funding from your investment portfolio. If your current standard of living relies on pulling money out of the stock market, you will eventually be forced to sell assets at exactly the wrong time. Even Warren Buffett's Berkshire Hathaway, arguably the greatest collection of assets ever assembled, saw its portfolio value drop by more than 50%, twice in the last 50 years. If an investor of that caliber experiences massive downturns, you must structure your life to survive them without panicking. That ability to endure panic leads directly to the second takeaway. Historically, dull and undervalued companies consistently beat exciting futuristic growth stocks. We can see this play out in this comparison from 1999. The entire financial world was caught in the dot-com euphoria. Buffett refused to buy into internet companies that lacked underlying value. Because of that restraint, Berkshire lost 19% of its market value that year, while the broader market soared by 21%. But the math always catches up. After the dot-com bubble burst, the market collapsed. Between 1999 and 2002, $100 invested in the general market shrank to $75. That same $100 invested in Berkshire Hathaway grew to $104. True financial security comes from ignoring the excitement of the crowd, researching tangible value, and holding resilient assets straight through the inevitable crashes. To hold those assets, we have to rethink our third takeaway, the definition of risk. Academic finance defines risk as volatility, how wildly a stock's price swings up and down. A value investor defines risk as the permanent loss of capital. This chart shows Apple's stock price from June 2012 to June 2017. The price wildly peaks and plummets, yet underneath this chaotic line, Apple maintained stable earnings, kept a deeply loyal customer base, and bought back billions in shares every year. The underlying business was a machine. The price swings were simply the emotional moods of the market. An intelligent investor views those temporary downward swings as a rare discount on a great business, rather than a threat. But you have to be careful what you buy on discount. That brings us to takeaway 4. Corporate management can easily engineer the illusion of growth by buying back their own stock. Here is how the trap works. Let's say a company buys back its stock at the S&P 500 average, which is roughly 3.29 times its actual book value. By paying a massive premium for those shares, instead of investing that cash into new factories or research, the company actively destroys its long-term book value. They are draining the business of future capital just to make today's earnings look higher. Protecting your capital means learning to spot the difference between a volatile market offering a discount and management quietly burning cash to fake their growth. So how do you find companies actually generating real value? Take away 5 points to a single metric, return on invested capital, or ROIC. This measures how efficiently a company turns its available cash into profit. Over a long enough timeline, the return you get on a stock will almost perfectly mirror the company's internal ability to compound its own capital. Let's look at Apple again, right around the 2008 financial crisis. Because Apple's return on invested capital was so strong, an investor could completely mess up their market timing and still generate massive wealth. This comparison shows the result. If you bought Apple in 2008, right before the market crashed, your capital still multiplied 6 times over the next decade. If you somehow managed to perfectly time the absolute bottom of the crash in 2009, your capital multiplied 14 times. Both outcomes are staggering. A consistently high return on invested capital acts as a shield against bad timing, proving that extreme patience, not psychic market prediction, is the ultimate financial weapon. Let's lock in the playbook. Detach your lifestyle from your portfolio. Prioritize boring value over exciting growth. Recognize that volatility is an opportunity, but permanent loss is the real risk. Avoid management teams that overpay for buybacks, and rely on return on invested capital to drive your long-term success. The hardest part of this strategy isn't the math, it's the psychology. We live in a culture built on instant gratification, and value investing requires you to sit quietly and do nothing for years at a time. How do you balance the need for long-term patience against a world that demands immediate results? Let me know your thoughts down in the comments, and while you're there, tell me the exact title of the next book you want us to summarize. If you like this video, please like, share, and subscribe to the channel for more.